Most people spend their whole financial life waiting for a loan to be approved, waiting for a bank to open, waiting for a card to work, waiting for the system to say yes. And the strange part is this: they call that normal. But normal is not the same as safe, because when your whole life depends on one outside system, you don't have control, you have permission. And permission can change when you need it most. Now, when people hear the phrase "be your own bank," many think it means something extreme, like hiding cash at home or trying to escape the real world or chasing a secret trick. That is not what we are doing here. Being your own bank is not a trick, it is a structure. A bank does three main jobs. It stores money, it moves money, it offers credit. So be your own bank means you build a small system that can do those jobs for you without turning your life into a fragile one-door setup. And here is the part that fast money culture will not tell you. Real wealth is built by people who can stay calm, not people who move the fastest, not people who chase the hottest trend, not people who act on fear. Compounding needs time, and time only helps you if you don't break your plan in a stressful week. Most people don't ruin their future because they picked one bad stock. They ruin it because of forced choices. They sell at the wrong time. They borrow at the wrong time. They chase the crowd at the wrong time. So in this video, we are going to build 5 ways to be your own bank, not 5 hacks, not 5 viral ideas. 5 simple ways to create more control, more access, and more calm. And we will do it with a rule-based mindset, owner mindset. Owners don't ask, what's trending? Owners ask, what keeps working when conditions are not perfect? Before we start, I want you to run one small test in your head. If one thing stopped working tomorrow, what would break your life? If your bank app went down, if your card stopped working, if your paycheck was delayed, if a transfer took longer than usual, would you be mildly annoyed, or would you panic? If you would panic, you don't have a money problem. You have a structure problem, and the fix is not speed. The fix is margin of safety. Margin of safety means you leave room for life to be messy. It is a buffer. It is a backup. It is a plan that still works when you have a bad week. So let's build it. Way number 1 to be your own bank is to build a cash ladder, not a cash pile. Most people keep cash in one place, one account, one app, one bucket. It feels clean, but it creates a single point of failure. Single points of failure are fine on perfect days, but real life does not give perfect days on schedule. A cash ladder is different. It has layers. Layer 1 is today money. Layer 2 is this month money. Layer 3 is calm buffer money. Each layer has a job. Today money is for small needs if something is slow for a short time. This month money is for bills and normal emergencies. Calm buffer money is what protects your long-term plan. Now, notice what we are not doing. We are not chasing the highest interest rate. We are not trying to win a finance game. We are trying to keep your life stable so you don't make panic moves. Here is the simple cash ladder question. If one account is blocked for 2 weeks, what breaks? Rent, food, medicine, transportation. If the answer is a lot, then your cash is not a system. It is a single point. Now do this quick exercise. Take a blank page and draw 3 columns. Today, this month, calm buffer. Now list where your money is in each column, not exact dollars, just where it lives. This is called a cash map. The cash map shows you the truth, where you are strong and where you are fragile. And here is the psychology part. The cash map also shows you why you feel anxious. Anxiety often comes from hidden fragility. When your money has no structure, your mind knows it, even if you don't say it out loud. Now let's add one simple rule to make the cash ladder work. Don't mix money with different jobs. If bill money is mixed with investing money, you will make mistakes. You will spend what should be saved, or you will invest what should be stable, or you will pull from investments too fast when life gets messy. Mixing creates confusion. Confusion creates panic. Panic creates loss. So the owner rule is separate money by job. And here is an inner script you can use when you feel tempted to ignore this. Say, my buffer is not for profit. My buffer is for peace. Peace is not soft. Peace is power. Peace keeps you from selling long-term assets at the worst time, because compounding only works if you stay in the game. Now, a common question is, how big should my calm buffer be? There is no one number for everyone, but there is a clean way to decide. Your calm buffer should match your essential life needs for a time window that lets you think clearly. Not your luxury spending, your essentials. Housing, food, utilities, medicine, basic bills. And again, this is not a promise. It is a planning tool. The goal is simple. You want enough buffer that a short disruption does not turn into a forced decision. Forced decisions are where people get hurt. Now, way number 2 to be your own bank is to build 2 doors for access. Most people have 1 door, 1 bank, 1 debit card, 1 payment app, 1 direct deposit, 1 bill pay setup. They call it simple, but simple can be fragile. 2 doors means you have options. If 1 door sticks, you can still function. This is what redundancy means. Redundancy is not fear. It is design. It is how strong systems work. Airplanes have backups. Hospitals have backups. Even your car has a spare tire. Not because trouble is guaranteed, because trouble is possible. So here is the 2-door rule. You want at least 2 ways to do essentials, 2 ways to pay for food, 2 ways to access money, 2 ways to receive money if possible. This rule is not about being fancy. It is about not being trapped. Now run this checklist. If your main card fails today, what is your backup? If your phone is lost today, how do you access your money? If your bank is slow for a week, can you still pay your most important bills? If you had to get cash today, what is your path? Most people don't like these questions because they feel uncomfortable, but uncomfortable questions create comfortable futures. Now, here is the biggest mental trap. People think they will figure it out later. They say, if something happens, I'll handle it. That sounds brave. It is often not true. In a stressful moment, your mind gets smaller. You don't become more creative. You become more reactive. So the owner rule is, set up your backups while calm. If it is important, don't store it only in your head. Make it real. Now, I want to pause and make this clear. These first 2 ways are not income streams. They are not investments. They are the foundation. They are what keeps you from panic. And panic is the hidden tax that kills most people's wealth. When panic shows up, people sell low. They buy high. They borrow wrong. They chase hype. They switch plans. So being your own bank starts with the boring part. Structure, layers, backups. Now, you might be thinking, this sounds like I'm preparing for the end of the world. No, this is preparing for a normal kind of disruption, a delay, an outage, a fraud lock, a messy month. And in modern life, messy months happen. Now, here is the bridge to long-term investing. A strong cash ladder and 2-door access do something powerful. They protect your investing behavior. When markets fall, you do not need to sell good assets to pay basic bills. When headlines get loud, you do not need to make a big fear move. When your friends start panicking, you have a plan. That is what lets you think like an owner. Owners don't react to noise. They follow rules. Now, in the next section, we are going to build way number 3. It is about credit. Not using debt to look rich, but preparing access to credit in a calm way so you are not forced into bad decisions when timing is bad. Then we will build way number 4, which is the real long-term engine, ownership in high-quality businesses with moats, fair prices, and patience. And finally, way number 5 will tie everything together, a simple monthly system for assigning every dollar a job so lifestyle creep doesn't steal your buffer and your future. Because the goal is not to look smart, the goal is to stay strong. And strength in money is often quiet. Way number 3 to be your own bank is to prepare credit before you need it. Most people do the opposite. They wait until life is already hard. Then they apply for a loan. Then they accept bad terms. Then they feel trapped. That is not because they are lazy. It is because they were never taught how banks think. Banks lend easiest when you don't need the loan. They tighten up when everyone needs money at the same time. They raise standards when fear is high. So the owner mindset is simple. You don't build credit access during the storm. You build it when the sky is clear. Now, I need to be very clear. This is not a message to borrow more. This is not a message to take on debt, to invest or live bigger. Debt can be useful, and debt can also be dangerous. Debt is like a tool. A tool can build a house. A tool can also hurt you if you use it the wrong way. So here is the rule for credit. Credit is a backup plan, not an income plan. It is there to protect you from forced choices. For example, If a payment is due and a transfer is delayed, credit can give you time. If a short emergency hits, credit can give you breathing room. Breathing room is what prevents panic. Now, here is the key difference between smart credit and dumb credit. Smart credit has a clear purpose. Smart credit has a clear payoff plan. Smart credit has a clear limit. Dumb credit is used to support a lifestyle you can't afford. Dumb credit is used because you feel behind. Dumb credit is used with hope, not math. So use this checklist before you ever borrow. 1. What problem am I solving? 2. If my income drops, can I still repay? 3. If rates rise, does this still work? 4. If the plan fails, what is the worst-case outcome? 5. Am I borrowing to build value or borrowing to feel better? That last question saves people, because many money mistakes are not math mistakes, they are emotional mistakes. Now, a lot of people like the phrase borrow from yourself. It sounds safe, but even borrow from yourself has rules. It has timelines. It has risks. It can create taxes or penalties if it is done wrong. So the calm rule is this: don't borrow from any system you don't understand. If you can't explain the rules in simple words, do not rely on it as your lifeline. And here is a second rule: never build a plan that depends on credit to survive every month. If you need credit to buy groceries, the problem is not credit. The problem is your base. That means your spending is too high, or your buffer is too low, or both. So credit should sit behind your buffer, not in front of it. Buffer first, credit second. That is owner thinking. Now, way number 4 to be your own bank is the long-term engine. This is the part that actually builds wealth over time. Way number 4 is ownership. Banks make money because they own assets. They own loans that produce interest. They own systems that produce cash flow. If you want to be your own bank, you also need ownership, not gambling, not hype. Ownership. Ownership means you own parts of real businesses that produce real cash over time. This can happen in different ways: public companies, private businesses, funds, your own business. The exact path depends on your life, but the principle is the same. You want assets that can produce value while you are doing other things. That is how compounding becomes real. Now, the mistake most people make is they confuse ownership with trading. They buy because a price is going up. They sell because a price is going down. They stare at charts all day. That is not ownership. That is renting a feeling. So here is the owner test. If the market closed for 5 years, would I still be happy owning this business? If the answer is no, you might be trading, not investing. And trading can be fine for some people. But trading is not the goal here. The goal is a system that grows with time, not a system that needs perfect timing. Now, to invest like an owner, you need 2 things: business quality and a fair price. Quality without price discipline is dangerous. Price discipline without quality is also dangerous. So we use a simple quality checklist. Plain words. Does the business have steady demand? Does it produce real cash over time? Does it have manageable debt? Does it have a moat? A moat is protection. It is what stops competitors from crushing profits. A moat can be switching costs. A moat can be brand trust. A moat can be a cost advantage. A moat can be a network effect. A moat can be scale and distribution. If you can't name a moat, the business may be in a constant fight, and constant fights usually lead to lower profits. Now the second half is price. This is where bubbles trick people. Bubbles tell you price doesn't matter. Bubbles tell you the future is guaranteed. Bubbles tell you to buy now or miss out. That is FOMO. Owners do not buy with FOMO. Owners buy with standards. So here is the simple price rule. Never pay a price that needs a perfect future. If everything must go right for you to do okay, you have no margin of safety. Margin of safety means room for error, room for slower growth, room for bad years, room for surprises. This is not about being negative. It is about being honest. Now, here is a simple way to stay honest. Write an owner note before you invest. 1 short paragraph. What does the business do? Why do customers stay? What is the moat? What could break the business? What would make you change your mind? If you cannot write this in simple words, you are not ready to own it. This note becomes your anchor in volatility. Because volatility is when your brain tries to rewrite your plan. When prices drop, fear talks. When prices rise, greed talks. The note is the quiet voice that stays the same. Now, Here is the volatility script. Say this when prices swing. I don't own a price, I own a business. Then ask one question. Did the business change or did the mood change? This keeps you calm. And calm is the advantage. Now, we need to connect ownership back to the first three ways. Because ownership only works if you can hold, and you can only hold if your life is stable. If you have no cash ladder and no buffer, you will be forced to sell. If you have no two-door access, a small delay can create a big panic. If you have no credit backup, a short problem can become a long one. So your cash system protects your investing system. That is how you become your own bank. You build a base that keeps you steady. Then you build ownership that compounds. Now, I want to warn you about one more trap. The trap is leverage. Leverage is using borrowed money to try to grow faster. Leverage can look smart in good times, but in stress, leverage can force you to sell at the worst time. Leverage removes patience, and patience is what makes compounding work. So here is a simple leverage rule for a calm system. If a plan can blow you up, it is not a long-term plan. Long-term plans should survive bad weeks. They should survive bad months. They should not depend on perfect timing. Now, some people will say, but if I don't take big risks, I'll never get ahead. That is a common fear. But it is based on a false idea. It assumes the only way to win is to sprint. In reality, many people build wealth by not falling down. They avoid big mistakes. They invest steadily. They hold quality. They keep margin of safety. They stay calm. This is not exciting. It is strong. Now, in the next section, we will finish the system with way number 5. Way number 5 is the part that makes everything stick, because even good plans fail if you don't maintain them. We will build a simple monthly money meeting with yourself, a calm routine where you assign every dollar a job, protect your buffer from lifestyle creep, and keep your system strong without checking it every day. And we will end with a one-page checklist you can use for the next 10 years, because being your own bank is not a slogan. It is a routine, and routines build wealth. Way number 5 to be your own bank is to run a monthly money meeting with yourself. This sounds boring. That is the point. Most people do not lose money because they never heard a good idea. They lose money because they never built a routine that protects them from bad habits. They earn, they spend, they save what's left, and what's left is usually not enough. A real bank does not run on leftovers. A real bank assigns every dollar a job. So if you want to be your own bank, you need one quiet habit that keeps your system strong. Once a month, you sit down for 20 minutes. No scrolling, no panic, no hot takes, just a simple review. This meeting has 4 parts. Part 1 is stability check. Ask, are my next 30 days of essential bills covered? Housing, food, utilities, medicine, transportation. If the answer is no, stop. The job is not to invest more. The job is to fix stability first, because stability protects your behavior. Part 2 is cash ladder check. Look at your 3 layers. Today money, this month money, calm buffer money. Ask, did any layer get thin this month? If you used your buffer, that is not failure. That is the buffer doing its job, but you should rebuild it. A buffer is not a decoration. It is a tool. Part 3 is single point check. Ask, do I have any new single points of failure? For example, did you connect more bills to one account? Did you start relying on one card for everything? Did you move everything into one app because it was convenient? Convenience can quietly rebuild fragility, so your job is to notice it early. Then you fix it with one small step, not 10 big moves. One small step. Part 4 is allocation check. This is where you decide what the next extra dollar should do. This is a simple question. What is the best use of the next dollar? Buffer, debt, or ownership? Buffer means building safety and time. Debt means reducing a fixed cost that makes your life fragile. Ownership means long-term assets that can compound. There is no perfect answer every month. The best answer depends on your current weakness. A bank protects its weak points first. You should too. Now, there is a big danger that this monthly meeting protects you from. Lifestyle creep. Lifestyle creep is when your spending rises every time income rises. It feels normal. It feels earned. It feels like progress. But it can quietly kill your system because it destroys your buffer. It destroys your ability to invest steadily. It increases your need to borrow. It makes you fragile. So here is a simple rule. When income goes up, increase your buffer and ownership first. Then increase lifestyle slowly. This rule feels unfair at first, but later it feels like freedom. Because freedom is not what you buy. Freedom is what you keep. Now, the monthly money meeting also helps your investor psychology. It helps you stop checking everything every day. Daily checking makes you emotional. It makes you react to noise. It makes you feel like you must do something. Most wealth is built by doing the right things over and over, not by constant action. So set a rhythm. Daily life runs weekly. Money review runs monthly. Deep investing review can be less often. The point is to stop living inside your alerts. Now, let's put all 5 ways together. This is the full Be Your Own Bank system. Way 1, cash ladder, layers of cash with different jobs. Way 2, 2 doors, backup access for essentials. Way 3, prepared credit. Open access during calm times, use it like a tool, not like oxygen. Way 4, ownership, high-quality assets with moats, bought with margin of safety, held with patience. Way 5, monthly money meeting, a routine that protects the system and stops lifestyle creep. Notice what these have in common. They are not flashy. They are not based on guessing the market. They are not based on luck. They are based on structure. Structure is what keeps you calm, and calm is what keeps compounding alive. Now, I want to give you a simple 1-page checklist you can use. You can write this down. It is called the Own Bank Checklist. Here it is. 1. Do I know my essential monthly expenses? 2. Do I have a cash ladder with 3 layers? 3. If one bank door is blocked for 2 weeks, can I still function? 4. Do I have a second way to pay for essentials? 5. Do I have a written plan for stressful weeks? 6. If the market drops, will I be forced to sell long-term assets? 7. Do I borrow with a plan or with emotion? 8. Do I invest like an owner or do I chase price movement? 9. Do I have a simple monthly money meeting? 10. Do I have no panic rules? Those no panic rules are important. Here are 3 you can borrow. Rule 1. I will not make major money moves while scrolling. Rule 2. I will not move everything at once because I feel fear. Rule 3. I will verify facts, then act in steps. Now, let's talk about what being your own bank is not. It is not hiding from the world. It is not trying to outsmart everything. It is not avoiding all risk. Risk exists. Markets move. Life is messy. The goal is not to remove uncertainty. The goal is to stop uncertainty from controlling you. That is what margin of safety is really about. Margin of safety is the space between you and panic. It is the space that lets you breathe. It is the space that lets you wait. It is the space that lets you think. And thinking is the advantage. Now, here is the final mindset. A bank is calm, even when the world is noisy. It does not make decisions from fear every hour. It follows rules. It protects the base. It keeps liquidity. It lends carefully. It thinks long-term. That is the mindset you are building. So if you want to start today, start small. Draw your cash map. Create your cash ladder. Build a second door. Write your 1-page plan. Schedule your monthly money meeting. That is it. No hype. No rush. Because the real win is not one clever move. The real win is a system you can follow for years. And if you can follow it for years, compounding finally gets the time it needs to work.